Welcome to The Real Recipe, the podcast that brings you the perfect blend of real estate trends and topics, where we serve up fresh insights and sizzling strategies. So let's get cooking. All right, we're back with another episode today. You know what? It drives me nuts that we're not doing numbers because I don't even know like how many we've done so far.
It is a number. It's the mustache episode.
It's the mustache episode.
I brought his mustache.
So just
today.
so you know, this was a joke with my kids. They think that I can't do it. You know, so it is hysterical, but it will go away. So this is a one-time.
You're gonna do the thing where you're like
one time only.
You're acting like don't really like it, but you're gonna let it grow out for like a couple months, and then you're gonna be like curling it and doing all this stuff and buying all this special product for it.
See, what you don't know is that I'm Irish and German, and you know this is not this. It will take years to grow.
That's not true.
Yeah, well.
My husband's the same nationality as you.
Oh my God! Well,
and it grows in like 4 seconds.
Oh, not mine. Not mine. This will take me.
I'll send you his product list.
All right, fair enough. Because that'll become a thing soon eventually.
Right.
I'm gonna need to know like all the beard oils and it start curling up the ends. Oh yeah, I'm sure my kids would be thrilled by this.
Anyway,
so today we're gonna talk about some an interesting conversation that I've seen popping up more recently. Mm-hmm. A lot of people are talking about different creative ways to still access some of the low rates that have that people got over the last couple of years through COVID and when rates got really low. And one of the ways that people can actually access a lower interest rate right now is if you are selling your home as a seller and you have an existing FHA loan on your property, and let's say you have a phenomenal interest rate of 2.5-3%,
right?
Your FHA loan under certain circumstances is assumable, meaning the person buying your home can take over your mortgage. So we'll talk about that today. We'll talk about what does assumable mean? What does FHA assumable mortgage mean? What are some of the basic ins and outs of it? And we'll talk about, how it can be done. And if you're a realtor, one of the questions that you should be asking your sellers, if you're a listing agent, hey, what kind of mortgage do you have? Do you have an FHA mortgage? If you do have an FHA mortgage, it may be assumable, which may make that sale much more appealing in certain circumstances. So, it's something to consider. It's not right for every single person. It doesn't work for every single situation, but hey, it's an interesting topic. It's pretty cool. So
starting at the beginning then, because you brought up an important point. If I'm a listing agent I want to talk to my seller about that, and they have an FHA mortgage, is there something that they can check with their lender ahead of time just to find out if it is assumable? Obviously, it's going to be completely based, just like a regular mortgage, going to be based on the borrower's qualifications. But can the seller be reaching out to the mortgage company and asking ahead of time, is my mortgage assumable, provided, if it's FHA? Okay.
Yeah, absolutely. So the long and short of it, the way it works is, you couldn't, let's say I have a relationship with you as the agent.
Okay.
Right? You couldn't just come to me as a mortgage person and say, hey, I have this client, they want to assume the mortgage. I can't do anything for you in that scenario.
Okay.
You have to go to the current mortgage company
who's holding the note.
That's holding the note or servicing the loan.
Right.
And you would basically go to them and ask them, hey, what's the process for somebody assuming this mortgage?
Okay.
And they should have a process. More often than not, they're going to have a process for that. And you would qualify for it just like any other mortgage. Have to have minimum credit score, I think, of 580. That may be dependent upon the servicing company and what they'll allow to assume a mortgage. But generally speaking, you have to qualify for a mortgage just like a normal mortgage. You have to have minimum credit scores. You have to have minimum or maximum debt to income ratios. But yeah, your first point or your first starting point is to call the servicer or whoever's handling your mortgage and say, hey, I have an FHA. Can that be assumed by somebody, or will you allow it to be assumed? And if they say yes, then they'll tell you what that process is. And it's, again, a normal mortgage process. It's, the person who's assuming the mortgage has to, provide pay stubs and W-2s, tax returns, and qualify, like a normal mortgage. So.
Okay. I mean, obviously, from a title perspective, they still have to hit all those qualifications too, because they're still technically transferring title. So we have to run the same search as we would.
Yeah.
As far as closing costs and mortgage insurance go, so say you have someone who's coming in and they could qualify for, a conventional mortgage, but they want to assume this mortgage because it's got a fantastic interest rate. What does that look like for them as far as closing costs and any other additional costs compared to getting their own regular mortgage?
Great question. Closing costs are from a lending side of things, are probably going to be slightly less.
Okay.
But what you'll inevitably find is that, the servicer is going to charge some kind of fee. Who's ever handling the mortgage is going to charge some kind of fee to process
like a loan application
the assumption.
fee.
Yeah.
The assumption. Okay.
They may or may not want an appraisal on the property. In most cases, I believe with the assumption that there is no appraisal that's required on it.
Okay.
But again, that's servicer specific. As far as fees are concerned, like I said, they're probably charged some kind of transaction fee or some kind of application fee or some kind of processing fee to actually handle all this stuff. And for the most part, it is similar in terms of a mortgage. The only thing is you're just transferring the mortgage from one person to the other, and they're just assuming that mortgage that you already had. So
same timeline as applying for a mortgage, or would you say quicker?
I would probably I would default to it's probably the same.
Okay.
As much as I think that it could be quicker, because you already have a lot of the nuts and bolts already built into the mortgage, you already have a lot of things done already. I can also see where it's going to be. You're more often than not, the servicer is a much larger organization, larger entity. And typically when you're dealing with bigger banks and bigger mortgage companies, there's always...
Right, because they can't just go to you as the broker for this. They have, like you said, they have to reach out to the current note holder.
Right. So, you're going to go to a large bank or a large mortgage company to try to do this. But everybody who's dealt with those types of larger types of institutions knows that it's a slower process. Regardless. And this is a good example of a situation where it's probably going to be on the slower end rather than on the speedier side of things.
So I guess my next question then is, someone's assuming the mortgage, they're assuming it based on that current loan amount though, correct?
Yes.
Yeah.
Yes.
So when you write up the contract,
right. So you
have to know that ahead of time.
Yeah. So this is where the fun part comes in, right? Okay. Like, how does this all work? So let's say you paid a couple of years ago, maybe you paid $350,000 for it, and maybe you put down, $50,000. Okay. So your loan amount at the time was maybe $300,000, right? Now it's been a couple of years, and now maybe you owe $270,000. But as we've seen with real estate, now your real estate value has gone up to $550,000.
Right. So that's what I'm thinking. They're paying such a much more inflated price.
They are.
How do you keep?
So if you think about it if you just think about it from a in its totality, right? And you look at your mortgage payment and you say, okay, if I get an FHA loan at 2.5% and I'm putting down, let's say I'm putting down 30%, okay, right? And you're, it all 40% or whatever the number is, it all works out, and you can assume that mortgage. So you're coming up with, let's call it $270,000 or $280,000, right? Whatever the numbers. But you're getting 2.5%,
right, on
a 30-year fixed loan that's already now a few years in, right? You've gotten the benefit of a shorter time frame, right? You've also gotten the benefit of a lower interest rate, okay? So even when you start to work the numbers, you look at the interest rate plus the mortgage insurance that you pay on FHA, so maybe your all-in interest rate comparing to a conventional loan is maybe 3.5%.
Right.
Maybe 3 3/4, on the high end of things.
Okay.
Right? Today's interest rate on a 30-year fixed conventional, 6.25%, 6.5%. 6 3/4.
Right.
I mean, you do the math. I mean, your payment is substantially lower. Substantially lower. So why wouldn't you? Why wouldn't you at least entertain it? You know, yeah, it stinks because you're paying mortgage insurance. Okay, fine. I can appreciate that. But, you know, at the end of the day, your
right,
payment...
But really, your payment is so much lower, though.
Yeah. I mean, why wouldn't you do that?
Right.
I mean, why wouldn't you at least consider it? You know, at least... Because at the end of the day, who cares? You know, if you're writing that check on a monthly basis, what do you care? Mm-hmm. You know, it's not going to matter. You know, and you know, if you're comparing you know, apples to apples, payment wise, I mean, you're going to be, you know, several $100s cheaper. You know, just by virtue of assuming the mortgage. I mean, why wouldn't you? I mean, and you're going to have that rate for the rest of
It's just interesting because I'm not hearing anybody talk about this at all. I mean, the only time we've seen this happen, I feel like often is when like a family member or a friend is, you know, more so a family member, like someone wants to take the mortgage over for their parents or something like that. And their parents don't want to sell them the house. And this is really the other alternative. They can just assume it at whatever loan amount they have because there's really no consideration amount. They don't want to sell it to them.
I know, but think about it in this way. Think about it. You could potentially get, if you're the listing agent and you're the seller,
right,
and you're offering your mortgage of 2.5 or 3.5% as part of the deal from an assumption standpoint, or you're assuming that mortgage, you're going to get a lot of people who are interested in that and go, okay, hold on, wait a minute. I can get a 2.5% mortgage on this?
That's what I'm saying. Nobody's even bringing this up as a possible concept for a tool.
Right. And think about that for a buyer. You put that in the listing description, right? Seller currently has an FHA loan with 2.5% that is assumable.
Right. I'm thinking more so of people who don't want to sell their house right now because they have a phenomenal interest rate, and maybe they have an FHA mortgage themselves, but now they need to get a bigger house.
Sure.
You know, connecting with a realtor, like just having someone put it out there. Like I have a buyer or seller who's looking to sell. They're looking for someone who's got a house with an FHA assumable mortgage so they can keep within the same range of that interest rate that they have now. Because that's really what stings the most with sellers right now is like, even me too. I would love to sell my house right now, but I don't want to give up a 2.5% interest rate and pay more money, even if I wanted to buy a smaller house.
I know. It's wild. Well, and there's some other concepts too about, you know, one of the next podcasts that we're going to do, we'll talk about like saving money because, you know, even though you may be giving up a 2.5 or 3.5% interest rate, you know, if you've got enough equity now where you could pay off other bills, you could literally go from 2.5 to 3.5 or 2.5 to 6%, you know, but because you've built up so much equity, you could pay off all your debt, you know, so even though you may have a slight increase in your mortgage, your net monthly payment,
debt ratio in general is lower.
Yeah, so there's people. I think people aren't thinking about things
as a whole.
As a whole, like and this the FHA assumption thing is one of those things where the agents who are the first point of contact with the seller, they're not asking that question. And partly because they just don't know to ask the question. Like, hey, I didn't know FHA, you could assume it.
Right.
That's amazing. You know, like, and you have to think about it too. Like in certain towns, in certain wealthier towns, the odds of having an FHA assumable mortgage in a wealthier town are lower, and it's not gonna work. However, in, you know, more middle class areas and lower middle class areas, you'll find a lot of FHA loans because they made sense for the individuals buying them. Maybe it was their first home and they didn't put down a ton of money, but now they want to move up and they want to have all this equity. And maybe they don't have a ton of equity. Maybe they, you know, maybe that $300,000 house that they bought even just a couple of years ago because I mean we were doing 3.5% mortgages, you know, 2 years ago, year and a half ago. So I mean it's possible that they
didn't put too much of a dent in it yet anyway.
That the equity hasn't just jumped so much where you'd have to have this huge pile of money to do it.
Right.
But, you know, maybe you've got, you know, a $300,000 house that maybe is worth $450 now or $400, you know, and you've seen enough of an appreciation where you can get, you know, somebody who's going to put down 20%. And 20% on 400,000, maybe you put down a little bit more and you get the FHA loan.
Right.
That's a huge benefit for you. Just from a savings perspective on a monthly basis. You're talking about saving hundreds and hundreds of dollars per month.
Right.
And so, depending on when the FHA loan was taken out and, there's certain nuances to it, but, maybe after 11 years, the insurance comes off. Maybe the mortgage insurance is on there for the life of the loan. It's just going to depend on when the loan was taken out. But again, the interest rate and the monthly savings, comparing to a conventional loan in today's market, if you have the money to put down, FHA assumable. Oh yeah, FHA assumable is definitely the way to go, or a consideration to make for sure.
That's interesting because the one point you made, with any investment, people probably should be looking at it as how it applies to their portfolio or their debt as a whole. And they're not. They're looking at it as, if I have a house right now, I'm paying this interest rate, I'm paying this per month. If I move into another house, I'm paying this interest rate and this is my monthly payment. But if you're paying off all this other debt, people get so pigeonholed into like paying down one thing. Like they're like, I don't want to have, a high mortgage rate. Yeah. Meanwhile, they're paying some absurd amount for their car or the 29% on their credit card debt. Yeah. And they're like, they're fine with that revolving debt, but the other debt they don't want to have.
You know why? Because they look at the dollar figure.
Right.
They look at it. Oh, I have $10,000 on a credit card. That they in their mind justify that and saying, oh, that's not a big month.
That's not a monthly payment.
That's not a big number to me. However, that payment's still a couple $100, probably $200 or $300 a month.
Right.
Right. But they don't visualize, to your point. They don't visualize how much interest you're actually paying on that.
I think people don't want to.
They don't want to know.
They just don't even want to think about it.
I don't want to know I'm paying 29% on my credit card, but that's what happens. That's what people do. People they step over dollars to get to dimes, right? They forget that, like I told you before, right? If they sell their house and they have enough equity, they pay off all their credit cards. Yeah, they're getting a higher interest rate, but their net expenses on a monthly basis are lower. So why wouldn't you? If you could get an FHA loan, and the FHA is not a great loan compared to a conventional loan, partly because of all the mortgage insurance aspects of it. But if you can get an FHA loan at 2.5% or 3% compared to a 6% conventional loan, there's no question the FHA makes way more sense.
Even with the mortgage insurance.
Even with the mortgage insurance. So you're saving a couple $100 a month. Why wouldn't you assume it?
Right.
Just take the assumption. It makes sense. Financially.
Well, interesting take. Definitely, if you're a realtor or a seller and you're considering it, doesn't hurt to reach out to, if you have an FHA mortgage, doesn't hurt to reach out to your servicer, your note holder, just to get a basic idea on whether or not you can do it.
Yeah, you're doing a listing appointment. That's one of the things that I would be asking today is, hey, what kind of mortgage do you have on your property today? Do you have an FHA loan? And if you do have an FHA loan, did you know that loan can be assumed or potentially be assumed by a buyer? And that may equate to, hey, maybe instead of $400,000, maybe you get $420,
right?
Or $430 or $440. Not that wouldn't happen already today in our market, but you may have an instance where a buyer may be willing to pay up for a better interest rate on the mortgage and give you a higher value for your property, because that may also be part of the value of your property.
Isn't that what people were doing the last 2 years anyway? They're like, I could pay more because I'm just going to mortgage it over 30 years with a way lower interest rate.
Absolutely. So it's right. So everybody went crazy just saying, oh, I'm going to get 2.5% or 3% on a mortgage. Yeah, sure. I can spend $800,000. No problem. Let me write the check. Here you go. So it's an interesting take on things. It doesn't work in every situation.
Of course, but
it's not for everybody. It's not, yes, you have to, you're assuming the existing mortgage. So, one thing to consider, this is where this could also work for people, is, hey, maybe you do the FHA assumption.
Okay.
Maybe you buy the house. And then after you get into the house for a couple months, then maybe you go and take out a home equity line. Now rates on home equity lines aren't
that great either.
Aren't that great either. So probably going to wash out any savings that you may have with the FHA assumption, but you'll have an equity line in place, and you only pay for what you borrow on it. So if you're only let's say you have it for, just emergency purposes or any short-term needs. Yeah, okay, fine. Then that might make sense, So, there are other strategies or other ways to think about this rather than just, oh my gosh, I need a 30-year fixed mortgage. That's it. Let's, let me see if I can get the best rate out there. But the best rate may actually not even be out in the market. It may actually already exist with the seller. Yeah, with the seller. It's an interesting take on things. It's a little bit of a different perspective on it. And again, if you're a listing agent, ask the question. Why not? And if anything, it's going to make the house more valuable.
Yeah, I guarantee you that most listing agents aren't asking that question. So if I were a seller, I would find it, appealing that someone would ask me that question, just because it's another way I could potentially market my house.
Or how about this? If you're a listing agent, do the research on the property and find out if it has a mortgage ahead of time. There's resources out there for you to be able to find that, right? And so imagine that you're a listing agent going into a listing appointment, and you walk in and you tell the seller this, hey, by the way, you have an FHA loan and it's assumable, which means that you could market this in a different way. You are gonna come in completely different than every other agent who's going to come in and just tell you whatever value they think they could sell your house for. And you're going to look like more of a professional, like you did some research and you know what you're doing. Not that you wouldn't have done already research anyway, but you've gone the extra mile.
It's just a different take.
Yeah, different take, extra mile, and it shows that you're trying to get the most value for that individual.
Right.
Which would ultimately lead to, more listings and, more sales, obviously. So it's an interesting take.
Yeah.
It's a different way to think about things.
Well, good info.
Yeah. So, but next time I think we'll talk about, the conceptually on if you're going to jump from a low interest rate mortgage into a higher interest rate mortgage and paying off some of your debt, what that ultimately equates to and how much of an impact that can actually have. So we'll definitely talk about some of those topics next time.
Mm-hmm. We like saving money.
Everybody loves saving money.
Till next time.
If you have an FHA loan, it probably is assumable.
Right.
So call your servicer and find out.
Everyone's picking up their phones right now, right?
Yeah, everybody. They're dialing in. Ring, ring.
All right. Till next time.